Hello there and welcome to Dukascopy TV for the week ahead. I'm Doireann Mc Dermott and right now I'm joined on the line by a currency analyst at RMB in Johannesburg to have a look at some important events this week. Hi Nema, thanks for coming on the line today. Well Nema, first let's have a look at Asia. Now, what are your thoughts on Asia this week?
I think we've already had most of the Asian data out this morning, given that we're still living in very much of a two-speed global economy. The Asian markets are looked at in terms of being the impetus for global growth, and with Chinese growth coming off, there still are concerns as to whether or not it can sustain a momentum. We saw quite a harsh reaction from financial markets, commodity currencies, commodity prices falling quite drastically following that release. So I think that set the tone for the week, and it just remains to be seen whether or not any other data releases which we receive, being the second or third week of the month already, it tends to be a bit quiet in terms of your primary data releases. And I think it's more based on rhetoric on the part of policymakers and whether or not that stirs up any type of market sentiment.
Now, looking at Australia, RBA meeting minutes will be released this week. Now, what are you expecting to see in these minutes?
Well, we're probably not going to see anything different than was expressed following the MPC meeting earlier this month. The RBA have been quite clear in their sentiment towards inflation, economic activity. Inflation still staying well in bounds to allow further monetary policy easing, which seems to be the rhetoric of the Reserve Bank at the moment. Even though economic activity has picked up, what they're trying to do by cutting interest rates more particularly is to stimulate domestic demand. The consumer is still highly leveraged within Australia, but what we haven't seen is credit growth picking up, and we really require that in order to offset the potential slowdown in the mining sector. So we aren't going to see any type of surprises through the minutes, I expect, and as a result of which the financial markets should trade steadily. I think for the moment the Aussie dollar more particularly is linked to the ongoings in Asia and the Chinese data. We saw commodity currencies falling today on the back of that poor Chinese data. So I think it's far more sensitive to global happenings at the moment than anything domestically.
And Bank of England minutes will also be released on Wednesday. What type of impact do you see this having on the cable and on the euro pound?
Once again, it's quite similar to the rhetoric expressed in Australia in the fact that we aren't going to see much in the way of surprises. Since the new governor joined last July, he's been quite supportive of quantitative easing, but he has very few advocates as part of the MPC on his side. We could well see as part of the minutes that it is very much the same split in terms of those who are biased towards more quantitative easing versus those who are still afraid of unanchoring inflation expectations, even though the Bank of England has this new monetary policy remit which allows divergences from the inflation target. So as a result of which, yes, we might see a bit of intraday volatility, but the cable tracking quite closely domestic fundamentals. Domestic fundamentals within the UK still quite weak, but not weak enough to allow for the MPC to engage in any further monetary easing for the moment. With regards to the European crosses, when you're looking at euro versus the sterling, the euro is still drawn down by what's going on within the eurozone. So we expect that pair to remain quite subdued over the week, regardless of the minutes of the Bank of England meeting.
And Nema, looking at the eurozone, the highlight of the week is expected to be the ZEW survey, which is out on Tuesday. Now, the sentiment is anticipated to drop to 42 after last month's surprise decline to 48.5. But what are your thoughts on the eurozone for this week?
It's probably a conservative estimate if you look at the ongoings in the eurozone for the moment. 42 as opposed to 48.5, which it registered in previous months. That was its highest level since mid-2010, and that's the point at which the German economy was growing at around 5% or so. But As a result of the Cypriot bailout, the ongoing political tensions that we're seeing in Europe, or in Italy more specifically, it really has dented investor confidence. And that's played into economic sentiment, which we should see reflected in those figures this week. However, it's not a leading indicator. It is a second-tier data release. So it doesn't have a close correlation with GDP. GDP in Germany more particularly ticking over. I think regardless of the data within the Eurozone, we're still looking at the underlying political tensions. We still have the Cypriot bailout at the front of our minds, whether or not that's going to come through, especially since the market is still reeling from Eurozone finance ministers meeting last Friday. There's still also concerns as to whether or not Portugal and Ireland will actually have their bailout loans extended, and that's just to provide the governments with a bit of relief in terms of their short-term financing needs. But I think still what is tainting perception and investor confidence within the Eurozone and whether or not there will actually be a sustainable recovery remains the Italian political situation and the fact that we don't have any strong leader coming to the fore, and neither is there a strong majority. And I think until we don't see some type of resolution on that front, we're still going to be bopping and weaving within the range when it comes to the euro. At the moment, it's quite centered at around 130, but as we well know, the euro is susceptible to two-way risk on account of particularly rumblings within the Eurozone political spectrum.
And finally, Nema, let's have a look at South Africa, as markets expect inflation release to show that consumer prices rose 6.0% in March from a year earlier. Now, what are you expecting?
Well, we expect that inflation would have peaked above that 6% level at March. Our expectation is around 6.1%. Core CPI, however, quite anchored at around 5.3%. That's largely due to base effects. But I think the one thing that must be remembered is that March is a very high survey month in South Africa. We take into consideration education, rentals, vehicle-related insurance costs, etc. So that also feeds into that number. But aside from that, we also have the added weight of the sin tax increase, which actually comes into effect this month, but it's quite preemptive and filters into the numbers as of March. So what we think is that if we see a figure released above 6.1%, it definitely will be a negative surprise to the market, but an outcome below 6%, as we say, will be something positive to take into consideration.
Thank you very much, Nema. Well, viewers, don't forget to stay tuned to Dukascopy TV this week as the TV team brings you the very latest economic and forex updates. But for now, have a great day.